Alistair, I was reading an article. This portfolio manager comes out of Canada, and he recently said that investors should remain focused on the broader global economic picture. Quote, the gold rally comes as Congress debates a new funding bill that would cut taxes and increase government debt by nearly $4 trillion. I do remember, I'm going to ask for your opinion on this, your thoughts on this, but I do remember, because I read a lot about Ronald Reagan, and when he was in power, he was only talking in the billions of dollars that they had to spend extra. And here we go, 20 years later, now we're into the trillions, which for everybody who don't know, a trillion is 1,000 billion, right? But another $4 trillion, what's that going to do with not only inflation, but also price of gold? What's your thoughts?
The principal relationship here is between the spending of the US government in excess of its tax revenue and the level of outstanding debt. This matters because if there is insufficient tax to cover the debt and the accumulating interest, then by definition, the US government is in a debt trap. Now, what a debt trap means is that people who fund that debt begin to think, hold on a minute, we're not going to get repaid. And of course, with the government, it's not a question of being repaid, but being repaid in worthless currency, the government's worthless currency. So the debt trap here is the issue. If the economy turns down, then obviously the ability of the American people to fund government through their taxes diminishes. And this triggers the debt trap. The other way in which the debt trap gets triggered, of course, is if the profligacy of the federal government increases more than the ability of people to cover it in their taxes or to cover it in their savings, then one way or the other, that again triggers the debt trap. And this is the fundamental problem. This is why the US Treasury is finding it extremely difficult to fund its deficit in long bonds, in long maturity bonds. Nobody wants the uncertainty of what the dollar will buy over a long period of time. So the only buyers of long-term debt are pension funds and some insurance companies who have really long-term, long-tail liabilities, if you like, to cover. And this is why, if you look at the makeup of foreign interests in US Treasury debt, you have the Cayman Islands, which is the offshore insurance center. And you've also got Luxembourg, which is being used to effectively fund out of lower yielding euros into higher yielding US Treasuries. But everybody else is really standing to one side and saying, we don't like the outlook for the dollar. How can we possibly invest in something which is a maturity of 10, 20, 30 years? Yes. Now, this creates a problem for the US Treasury because their funding increasingly relies on short-term debt. And this is why, even though the rate is higher, let us say, than the 10-year maturity, nobody buys the 10-year maturity really, but the US T-bills are the primary means by which the US Treasury is now funding itself. That means that as longer maturities mature and they're replaced by shorter maturities, the annual rollover of debt speeds up. It gets greater and greater and greater. So one way or the other, the US Treasury is moving towards a real debt crisis. And this is beginning to be reflected in the US dollar's trade-weighted index. If you look at the chart of it, it is really quite horrendous, is the word I would use. And of course, foreigners aren't stupid. They see this, they see it's on a slippery slope, and it's not helped by the president saying the Fed has got to reduce interest rates, and we want to lower dollar to make, if you like, more favorable trading conditions for domestic industries. Now, this is not good news. And furthermore, as far as foreigners are concerned, they look at the administration, the Trump administration, and think, well, we don't really trust these guys. So I think this is leading to a huge, great debt rollover problem, if you like. It is a debt crisis which is evolving in front of our eyes. The relationship between this, if you like, the confidence in the fiat currency, the dollar, and gold, then becomes obvious. Would you really want to hold something which is going to go down because it is being inflated, if you like, in terms of its quantity beyond anything reasonable? Or do you want to hold real, legal money in everybody's common law, which is gold? I think the answer is plain.
Well, what you've just said is always a brilliant answer, and I can concur. If I was lending money to the United States, I'd be wanting more than 5% on my money or whatever it is. I know the gentleman out there, the author, he said, I'd rather the return of my money than the return on my money. But in another sense here, I bring up the subject of buying a motor car in gold. And a lot of people have heard me say this, but if I bought a motor car at Henry Ford's production of the Model T, I would have paid out 18 ounces of gold, right? Today, I buy the equivalent of a Ford motor car, and I only pay out 11 ounces of gold, right? But it's the exact opposite when it comes to US dollars. You're paying $50,000 for that Model T, but you might get a bit more in there, but you're paying $50,000. So, yeah, that's the difference. That's really